Have you heard the term high risk, high reward? What does it mean? Does it mean to say to get a higher reward, you need to take a higher risk? In this episode, I am going to talk to you about whether you really need to take a high risk to get a high reward. This is NRI Money Clinic for you, and I am Dr. Chandrakant Bhatt, investment consultant and a financial planner.
NRI Money Clinic. No hype, just the right advice.
When I deal with my clients, we often get into a discussion mode. What is the return expectation of the clients? Many times clients tell me I need high reward. I am prepared to take higher risk. They are brainwashed into believing that to get a high reward, you need to be taking a high risk. When we say high risk is high reward, they forget the first part and they only listen to the second part, that is the high reward. Actually, the word high risk, high reward is not that you have to take high risk to get a high reward. It actually means that in your attempt to get high rewards, you may end up taking higher risk. That is the true meaning of high risk and high reward. In fact, to get a high reward, it is actually not required for you to take higher risk. In reality, high risk, high reward is a myth. It is the low risk, high reward is the untold truth. No one explains to you why this is like this. If you accept the fact that it is high risk, high reward, what will be the final event which will follow? It's not that you have to take high risk to get a high reward. If you accept high risk is high reward, then only one of the two will happen. Either the reward will follow, or on the contrary, the high risk will take its toll. It's not that you have to take high risk to get a high reward. In fact, in your enthusiasm to get high reward, probably you are taking undue risk and probably you are risking your capital. In fact, this equation of low risk, high reward is understood by none other than Warren Buffett. He understood this equation very, very well and he put it to practice. He knew what risk can do for him, how much behind he can be pulled because of that excessive risk. What this gentleman used to do in his practice of investment. He used to study the stocks, he used to study the different asset class. He would wait for an opportune moment for the risks to come down, and that is the time he will pounce on that particular stock or an asset class and he will buy into it. He knows for sure that when he buys that, there is no chance for it to fall further down. Even if it falls further down, it will not take much time for him to get back the money that he has already invested. Even if he has to wait for years to get back his money, still he will be rewarded with an absolutely good amount of cash flow by way of a dividend. And this has been the hallmark of the ace investor Warren Buffett. Let me explain this whole concept of high risk, high reward is a myth and low risk, high reward is the truth with the help of an example. I will take the example of a stock here. A disclaimer to add, I am not recommending anyone to buy this particular stock. I am just taking an example of this just to inform how low risk can result in high reward, or on the contrary, a very high risk can decimate your capital itself. Now we all know 2018 February, the small cap index was its peak. At that point of time, a stock called Bajaj Consumer. You would have heard about this company. It has a great brand. It's a debt-free company. It comes from a good pedigree. It was quoting a 500 rupees price. And everybody was chasing this particular stock. What happened next? People who bought it at 500 rupees in the next 2 to 3 years' time continuously saw the prices falling down. The price started falling down, and in the month of February 2020 or around March, the prices bottomed out to 100 rupees or 110 rupees. The dividend yield from this particular company touched about 10% in the month of February, March 2020, which means to say, if you totally disregard the stock price and if you buy this particular stock, because it has good brand, it has a stable business and it is debt free, chances of this business going belly up is extremely remote. If you have purchased that particular stock at that point of time, year after year, if the dividends are continued, I don't see a reason why it should not be continued. People would get 10% dividend yield year after year. Whatever the capital appreciation that happens is an extra boon or an extra profit for the investors. In fact, in my personal portfolio, I picked up this particular stock. I did not pick up this stock for the sake of capital appreciation. I am 58 years old and I am a great fan of cash flow strategies. So I looked at this particular stock and I picked this stock in quite a good number. What happened 1 year from then? Now, in the month of February, March, April, the stock was quoting 110, 120 rupees. A year down the line now, it is quoting in the range of 250 rupees, which means to say, having invested at a price of 120 rupees, it gave me 10% cash yield. Also, the money that I have put in to buy this particular stock literally got doubled. But it is still far away from the price of 500 rupees which quoted in the month of February 2018. Now understand here, in the month of February 2018, if you had picked up this particular stock, everybody was chasing this particular stock, you picked it up at 500 rupees, that means the risk was very, very high. What was the risk? The risk of the stock price falling down. And eventually, the stock price fell down and gradually it moved down in the next 2 years to 110 rupees. When it reached 110 rupees, the risk was lowest. There was no risk left in the stock because if you buy the stock, the company giving out dividend could add 10% of an yield to your kitty by buying this particular stock. Even if you had kept the money in the bank would have given you about 6% interest, whereas this company could give you a dividend of 10% year after year. And that is the point that I am trying to drive home here, is that if you want to be getting into a good reward mode, you have to wait for your opportunity, study the case very well and see whether it is worthwhile to buy a particular stock or a mutual fund, then pounce on it and grab it in full force. When people want to invest money, they go and ask their brokers or the advisors, how is the market doing? Is it a good time to invest in the market? Who will tell you the correct answer? No one will tell you the correct answer. They will tell you market is doing well, or they may say, yes, markets are doing well. But that answer will not answer your question, is it a good time to invest in the stock market? Instead, you ask the question in a different way. You ask this question, how is the risk in the market now? Is the risk high? Is the risk average? Or is the risk low? If the answer that you get is the risk is low in the market today, that is the time you have to invest in the market if your intention is to get a high reward. That is where the risk is low. The potential chance of you earning a high return will be highest at that particular point of time. Dear viewers, actually nobody will tell you what is the risk that is there in the market. You can find it out yourself. If you are a little bit observant and if you see what's happening around you, you can make out whether there is more risk in the market or there is less risk in the market. I will tell you a couple of ideas here. Number one idea, if everybody is talking about the stock markets, your friends, your colleagues, your people around you, if everybody is talking about the stock market, it only means to say that the stock market is inhabited by too many people and the risk is on the higher side. On the contrary, if nobody wants to talk about the stock market, if it is a hated word, or if people have lost money in the stock market, probably that could be the best time for you to invest money in the stock market because the risks have come down to the lowest point. There is one another way you can find out what's happening in the stock market. Look at what the mutual funds are doing. They will come on the television, but nobody will tell you that the markets is overheated because they want more and more people to invest in the stock markets. They can't just afford to tell you, please stay away. No, they will not do that. If more and more mutual funds are coming out with new fund offers, NFOs, at 10 rupee price value, it only means to say sentiments are favorable, risks are very high in the market. Mutual funds feel that they can grab a lot of money of the investors by floating NFOs. This is one indicator of risk. On the contrary, if the mutual funds are floating capital guarantee schemes, it means market is at a low valuation. People are struck with fears. They don't want to invest in the stock market. Mutual fund show has to run. So what do? They try to bring in capital guarantee schemes to cater to your mindset. If mutual funds are catering to the capital guarantee schemes in the market, it means the risk in the market is very, very low. Dear viewers, I would like to hear from you. We are almost at 52,000 on the Sensex. And for last 1 year, you have seen what's happening in the stock market. May know what's happening around you. Based on what you perceive, can you tell me where the stock market is at the present moment? Do you think it is at a high risk level? Do you think is it at a low risk level? Please comment below. Dear viewers, next time if you hear the term high risk, high reward, just remember when you take high risk, high reward could accidentally come to you. Otherwise, most likely it is the high risk which plays out and can knock down your capital beyond your imagination. So, high risk, high reward is a myth. In fact, it is the low risk, high reward which is the untold truth of this industry. Dear viewers, if you think I have given a point for you to ponder and if this helped you, please like this video. If you are a person who is watching this episode for the first time, or if you are yet to subscribe for this channel, please hit the subscribe button and press the bell icon. Don't forget to share this video with your near and dear ones. Thank you very much for watching this episode on NRI Money Clinic. I will be back with you with yet another concept, yet another video very, very soon.
Press the bell icon for more details and subscribe our channel.